Hello and welcome to Bondcast, our podcast series where we discuss the latest themes and events shaping rates markets. I'm Joann Spadigam, European rate strategist, and I'm joined today by our global market specialist, Stuart Sparks. So I think this week has really been all about tariffs and Trump's policy. The 9th of July deadline clearly has been one that has been pushed past now into August, with the effective date for tariffs now moving to August. And I think that of course leaves the market a little bit in limbo for now. But I think there are two things I think are important from this week's announcements. So I think firstly there's been a fairly mixed tone, I would say, on what the trade deals look like. Sri Lanka, for example, has got a pretty good deal, whilst others like Brazil are now in the limelight for 50% tariffs once again. BRICS have also been in question, and countries associated with the BRICS could have a higher tariff applied as well. But I think the second thing to note is actually the tariff letters that we've got this week have been fairly close, I would say, to the 2nd of April actual tariff numbers, which is perhaps a little bit of a surprise to markets. But I think overall the market's been a bit calm about the news for this week and really looking into next week. I'll let Stuart talk about this a little bit as well, but I think, of course, to me as a European rate strategist, one of the key things we've been looking out for is a European deal. And it seems at this point in time, at least, that a deal with Europe is not really finalized. They have said a deal could come soon. Our base case here continues to be for 10% for Europe, and it seems like that's where they're moving towards in terms of the deal that could be struck. But I think that, of course, it's one of the biggest partners of the US. This deal is taking a little bit more time to actually come through. So I think for me, whilst the market reaction has been pretty contained at this point in time, I do think that when I'm thinking about the risk to watch over the summer, it really is the risk that something does go sour. The market does seem quite, I would say, complacent to the risks of trade, and maybe that's because we've all come to adopt the posture that actually, Trump does chicken out tackle, as many of you will call it already. But I think that if I'm thinking about what the risks are to European rates over the summer, it really is to me that the trade deal could go quite badly, and that would mean that rates do rally a little bit from where we are now. I think, so for the very near term, I think that for duration, I'm not really in the camp of expecting rates to move much higher from where we are from now. I think range bound or perhaps even lower if actually the deal doesn't come through, or if there is a risk or a negative impact from the ultimate tariff at this point as well. So Stuart, turning to you a little bit, what do you make of this week's market moves and the trade deal as well?
Yeah, I mean, I think the tariffs are relevant in the sense that the deal levels seem to be coming in, as you say, closer to the Liberation Day announcements. I think on the margin, the weighted average effective tariff rate will probably creep up, which would intensify both the growth and inflation shocks. So nothing new there. I think there is probably room for a downside shock, and I think the market is likely to, again, react with this proclivity to buy the front end and put on steepeners. I think what is also interesting about the announcements is the period over which these are being announced and implemented is now stretching out, which becomes relevant from the perspective of a one-off sort of level shock, price level shock, vis-a-vis a broader period of tariff-driven inflation. It's going to make it harder for the Fed to ascertain whether the read-through from tariffs into domestic inflation is proceeding apace. If it's slow, how much it should be. All these sort of uncertainties are compounded both by the ongoing evolution of the tariff levels, but also stretching out the time. I think the market has focused on growth, but from tariffs. But there's another interesting theme developing in the background, and I think that's the amount of stimulus that has been delivered from various Trump actions. Just going down the list, I can think of four. The first is the currency has depreciated on a trade-weighted basis, both in real and nominal terms, by about 4%. The second is the Big Beautiful Bill, which is expansive from a fiscal perspective. It actually took the what would have been a small fiscal drag moving into fiscal 2026, and it pushed it into positive territory. Third, I would say the SLR reform is interesting because it essentially creates a credit ease. The 210 billion of bank capital that would be released, according to critics of the SLR proposal, will be deployed elsewhere. And if you think at conventional levels of leverage, that would be, 4 or 5 times. So you're talking about just from SLR as written, the growth in the aggregate bank balance sheet of something like $1 trillion. And I would add to that also that Wells Fargo Bank had its asset cap listed and is anticipated by many equity analysts, to grow aggressively. Numbers, at least as large as $500 billion from Wells Fargo, I think, are under discussion. And then lastly, the fourth item of stimulus is the 50 basis points or so of eases that Trump rhetoric has kept in the short-dated forwards. We don't think this is necessarily about politicization of the Fed explicitly, i.e., changing the mandate to make it politically accountable. Rather, we just think this is an action taken because the administration knows that if it gives some rabbit to chase, as it were, for the market, that the market will price eases. And in that way, Trump can go over the head of the markets. He can give the markets some inclination that rates would fall if he were to make changes in personnel. The markets are pricing that. So we've had a long period and could continue to have a long period of rates that are lower than they otherwise would have been. And that's a fourth source of stimulus. What's interesting is that in spite of the protestations of the administration that they want a more dovish Fed chair, this amount of stimulus, at giving the starting point, which was, again, a robust, although maturing economic cycle, the probability has actually risen that when a new Fed chair assumes the seat in roughly a year's time, that not only inflation could be above target, but growth could be accelerating due to the lagged effects of the stimulus, which is critically important because on balance it would be inflationary and more importantly, it would threaten to derail the strategy of the Fed, which we still perceive to be passive tightening, i.e., the Fed has to tolerate some slowdown in growth with respect to potential in order to move inflation lower. The stimulus might remove that decline and leave the Fed in a very awkward situation. So it's perhaps ironic, but a new Fed chair in a year's time could very well face a situation where the prudentially the first appropriate rate move would be a hike. And that would obviously cause a storm of controversy, I think, with the administration, but it could be prudent policy. And I think any credible candidate for the FOMC chair is going to proceed in that fashion.
So just following up on what you've said just now in terms of the Fed chair, do you think there's a risk that we could see that chair moving, the new chair really coming into force this year versus what Powell's expected to end at 2026?
Yeah, I don't think so. It's a credible threat. It is, I think, carefully engineered and designed to not upset the apple cart with respect to institutions and the process by which new chairs are selected. So there would be a shadow chair. I'm not sure that matters again because no credible candidate would commit to a particular policy action in 1 year's time, particularly given the domain, if you will, of risks that are affecting the market. So I think he could do it. And I think this is just about giving the market a plausible catalyst for pricing rate eases. Again, Secretary Bessent is a phenomenally successful Wall Street investor, a very savvy pair of hands for financial markets. And I'm sure that, personally, my opinion is that this sort of rhetoric was very carefully designed to influence markets, but not, again, create any acute damage to the institution. There's another interesting point lurking in here, which is the tension between fiscal and monetary policy, which people sort of lament, but it makes sense. And I think it's not going away. The reason it's not going away is because there's actually a Nash equilibrium in restrictive fiscal policy, or excuse me, restrictive monetary policy and expansive fiscal policy. If you think about the fiscal authority as wanting growth and the monetary authority about wanting restriction or being an inflation fighter, and you give them combinations of policy, restrictive or expansive, both on the monetary and fiscal front, the ordering suggests a Nash equilibrium just where we are, which is expansive fiscal policy and monetary restriction. What becomes interesting here is that the room for fiscal overhead is limited given the starting point in terms of debt to GDP. It implies that although the Nash equilibrium is for expansive fiscal policy, the limited headroom tells us that this pressure on the monetary authority to provide ease going forward is not going away. So we could even imagine a time, as a thought experiment, moving forward a year, and a new Fed chair comes in, and growth is above trend and inflation is accelerating. Trump has said in that sort of instance, well, that new chair should then tighten later if, as appropriate, he just wants a cut now. The pressure on the monetary authority for sources of stimulative policy, will continue. I think that's a legitimate debate, but it's not to the point where there are changes afoot for the congressional mandate for the Fed. When that reaches the floor of Congress, we'll worry about it. In the interim, I think we're stuck in this situation where the lack of coordination between fiscal and monetary authority guarantees the outcome. And these pressures, again, I think are structural. It turns out that fiscal policy has really never been used to tighten except once, and that would have been in 1968. And so it's hard to know if it's a chicken or the egg. Does the Nash equilibrium exist because Keynesian economics are only used in one dimension, or is it that the Keynesian economics are only used in one dimension because of the Nash equilibrium? But in this sort of situation where debt stability is quite important, it's worthwhile to understand that these natural tensions are there for sort of structural reasons, and this interplay between fiscal and monetary should continue.
And in terms of debt sustainability, one of the things we've been speaking a little bit about this week on the desk is how that plays with population dynamics as well. So what do you think the impact is of an aging population, for example, on long-term interest rates as a result?
Yeah, the source of pressure on the long ends globally is absolutely demographic in nature, which is why it's so widespread. And effectively, there's a wave going through the population, and that wave is the bulge in the population distribution from baby boomers. There are a lot more baby boomers than there are in the generations that will be funding their healthcare, and benefit structure after retirement. So when there's fewer people paying in than there are taking out, then obviously you have this need to transfer, but the numbers don't really work. The arithmetic of the social welfare state as currently constituted does not work. And so everyone, or major economies, are all trying to borrow for the same reason at the same time. Now, this is one source of legitimate fiscal pressure, potentially. But again, my view is that global markets are thinking of this with respect to the underlying and very structural demographic problem. This is all, in my mind, being viewed as by the market as raising the probability that ultimately fiscal authorities will attempt to monetize, or the consolidated authority between fiscal and monetary will seek to reduce the real value of debt, essentially just letting inflation run high. And I think the risk premium we're seeing attached to global long ends is essentially the risk of soft default. It's the risk of structurally high inflation as a policy choice, which would erode real returns. And again, with respect to the U.S., what this tells us is that one mitigating factor for this very structural dynamic would simply be returning inflation to target, i.e., demonstrating that that policy can be set both for inflation and growth. And again, as I say, this would be a process of re-educating the market as to how policy is formed in the case where the two pillars conflict. Again, here the problem is to get inflation lower, we need to slow down in growth with respect to potential. And if we don't get it, then the Fed's going to have a problem. The Fed's going to be stuck with above target inflation. And if falling inflation doesn't raise real rates and push inflation down, then it's possible that nominal rates could have to rise. Now, again, that's not a near-term forecast, and certainly is not in our projections. Our projections remain for no Fed change at all. But I think market prices could be driven simply by perceptions of probability around that. One, I think, deceptively powerful theme is that the probability of these higher rate, more hawkish Fed scenarios is underpriced in the markets at present.
Thanks, Stuart. I think just to wrap things off, let's talk a little bit about European markets and our medium-term views here. So I think as it's been a fairly quiet week in Europe the last 2 weeks, it's really been global moves that have driven European markets. So I did note before that with the tariff situation still very live, that I think at least in the near term we could see bonds and European rates fairly range bound. But I do think for me that there are still very much bearish pressures on the horizon and medium-term bearish risks to where we see bonds over the next year and in the months ahead, for example, in September. I think a couple of things are important to note here in terms of where we see bearish pressures in bonds coming from. The first is our ECB view, where, of course, the market is pricing in some degree of extra easing through this year. Around 25 basis points is being priced in additional easing versus our base case of 2% in terms of ECB rate. Now, the decision is pretty live, I think, and the discussion is very live, just given the fact that there's obviously a pretty dynamic global environment for the ECB to be dealing with, including the exchange rate, which is appreciated quite significantly in recent months. But I do think overall, when I think about the risk to Europe, the inflationary narrative is still very much in line with expectations. And whilst inflation could be lower next year, I think of that at this point as still a base effect. So we'll be watching to see what ECB policymakers do think, but I do think overall our 2% base case does remain intact and could bring some bearish pressures if we do get clarity on that from the ECB. The second thing I'll note is just that the global picture matters and that global supply does matter. We obviously have experienced over the last 2 weeks, firstly, bearish pressures in Europe stemming from supply in Europe, but also from fiscal pressures and fiscal policy in the UK and in Japan as well. This week there's been concerns about Japanese fiscal policy with a new government moving into power. And of course with the UK a couple of weeks ago when we did have a little bit more uncertainty on the fiscal picture there. And I continue to think that this global picture of expansive fiscal policy will have implications not just for Europe from a local perspective, but also from a global perspective as well. We've updated our funding numbers for the year this week, and I think that we're seeing an additional 25 billion in European supply coming from both Germany and Belgium, which is related to defense spending. And I think that theme, that topic will continue to run in the many years to come. And in contrast to the US, I just don't think that the levers or the tools to reduce the impact of supply are being used at this point. Deregulation is not really a topic we're discussing very much in Europe. And I think similarly, the European DMOs have not really stated that they plan to shrink issuance very much. So I think net to me, the way and the direction of travel for European rates is still higher at this point. The summer may be sleepy. We might have a couple of quiet weeks in Europe. August will bring the tariff deadline once again. And I do think September will see a re-engagement with both our ECB views as well as the idea that actually supply can matter a little bit more. But I'll leave it at that. And thank you to our listeners for listening. Thank you to Stuart for joining me as well. And we hope to speak next week.